All right, good morning. Welcome to today's third Thursday marketing meeting. We have a great lineup for you today. We have Brooks York, Director of Producer Services, Sterling Smith, Director of Ag Research, Mike Duhill, our corporate agronomist, and a very special guest, Charlie Laird, who is Director of Origination for Consolidated Grain and Barge. So wanted to make sure you just knew what our team provides. You can contact us with any questions that you have regarding your crop insurance and how that works with the markets and what's going on in the ag industry today. We also want to remind you of our upcoming June 30 stocks report webinar. We will be live with that. I want to show you a quick promotional video real quick. So don't you feel like Brooks and Sterling should be coming in wearing tape on this? I think they should. I think that's how they should start this whole meeting off. Anyway, we do have.
We didn't get the full effect of that, Christy. I mean, it's a lot better with sound. We didn't get any sound with it. It was a little choppy, but yeah, if you guys can imagine some superhero music in the background, that's what it's pretty impressive whenever you get to hear it.
It is, and you will see this out on all of our social platforms actually right after today, and it will be included in this video as it's recorded. We will make sure that the sound and everything is in there because it's pretty cool. So anyway, if you do want to register for this event, we would ask that you do that, and you can always send us an email at marketinginfo@sompointernational.com, and we will get that registration link to you right away. Brooks, I know there's a lot going on. Sterling's had a lot of really good tweets out there and some that kind of make me step back and wonder what is going on. We've got a lot of news, and you guys really have the information to walk our producers and our agents through any effects that are going to be to crop insurance and operations. So I'm going to pass it off to you. You let me know where you need me to go. If you're ready for me to share the screen with
Sure.
you,
I tell you what, I'm going to share my screen very quickly. We're going to take a look at the markets to kick things off, and you don't have to take too much of a look to understand where we're at today. We've got red really across the board, and if you guys can give me a thumbs up that you can see my screen. All right, so we look at the corn situation, and we're in a little bit of a slide here. You see new crop down 20 cents. Keep in mind, we're still 551, 552 here on the board. Taking a look at soybeans, if you can see the cursor that I've got on the screen, and if you're watching on your phone, I kind of fill you in. We've got November beans down 31 cents. The wheat complex, especially in Chicago and Kansas City, is lower. We're mixed up in Minneapolis. So it's an ugly day, and it's actually been an ugly week. And I don't know if you read the DMO last night, but if you've ever been on vacation with young kids in a vehicle, the question that gets asked over and over is, are we there yet? And this week, my phone has rang with farmers across the country, a few agents as well, saying, is this market done? Are we over? Is the rally over? And the reason we've compiled the folks who got on the call, of course, Mike and Sterling are regular contributors. We've added Charlie this week, and Charlie is the Director of Origination over at CGB. And Charlie, I don't see any friendlies on here in regards to Ohio State fans at the moment. I see we've got some North Dakota State folks, probably some North Dakota folks. I know some Kentucky folks, some Mississippi State folks. So you may be on your own with Ohio State today, but I brought Charlie in to really give us a view of the cash market and logistically how the crop's moving. So today, we want to tackle that big question of, are we there yet? Are we done? And we're going to have some different looks, whether it's Mike on the weather and from an agronomy standpoint, Sterling's going to talk about macros. Maybe we're moving in sympathy with other things, and then Charlie again going to talk about the cash market and logistics. So I'm going to throw the question out there, and I'll have several questions to answer. But Charlie, since you're our guest, I want to ask you today. You see things through a different lens than we do. You see the physical grain move on the river system, on the rail system. If you were asked that question by a farmer today, are we done? Is this rally done? Are there any clues that you're seeing from a cash market perspective that would give us any insight to that?
Yeah, we're starting, the old adage that the cure to high prices is high prices. So as we move forward through this and as prices have ramped up, you start seeing demand slip. So it may not be in huge pieces, but you'll see feed usage slip a little bit as people start looking at alternatives. You'll see export demand slip a little bit because of the same type scenario. They'll find other alternatives. You see ethanol that has slipped a little bit. You've seen soybean processing demand, again, slip a little bit. And then also you'll see a cargo of beans come on to the East Coast. So again, this starts as you move forward, you start seeing little slippages just because prices are getting to the point where it's very hard and they find alternative resources that'll compete against it.
You mentioned all those little components, and we've talked a lot about them in these Third Thursday marketing meetings. It's a little bit here of usage, a little bit there. We saw that this week, probably most in soybean processing. So our crush numbers were off just a little bit percentage-wise. I don't think it was a big number, like 2%, 2.5%. We're coming into a critical time of the year where July and August, if we lose numbers on processing, they typically occur in July and August with some extended shutdowns. You guys are in the processing market as well, in a pretty tough place to originate beans right now, in a high-priced area in the Ohio River Valley. Do you anticipate, internally, you guys seeing any little slip, or nationally, do you think nationally we'll see a continued slip there?
Well, I think the big thing this week that came out was, some conversation that the refiners on biodiesel can start asking for some grants coming from the government that they can scale down some of their usage and some of their blend. What we've seen, and again, the one thing that the producer needs to understand, the market doesn't act in a void. Everyone's known that we have a supply situation, and we've been building up, in our situation with the soybean plant. We've got enough stocks basically to get us through the new crop. And if it tightens up any at all, then, we will take some downtime to adjust accordingly. And I think the market in general, I think on the soybean side has done a good job getting coverage. I think on the corn side, depending on what the ethanol folks do, there's still some holes out there that they need to be able to. So, again, this isn't being done in a void. So the one thing the producer needs to do is understand that the market has been reacting for the last 6 months trying to get prepared for this summer.
So I think from something that an agent or a farmer can take from that comment right there, that I wholeheartedly believe is, a lot of times we might be caught off guard by something happening to supply. We've had time to react to it. What that probably means as well is basis levels may not be as extreme as they could be if we hadn't made those plans. So in a lot of cases, we look for early harvest premiums, which there's probably going to be some early harvest premiums there, but they may not be to the point that, say, they were in 2000, coming out of 2012, going into 13. Would you agree with that? Do you think we're going to see elevated levels, but not to the extreme that we've seen in the past?
Yeah, the market has to react to the unknown. So to push it to the next level now, we have to have something that changes. So right now the market is banking on early harvest to be able to fill in the pipeline as we get into the late summer months. So, if we start getting into late August and early September and the South starts getting wet, we start seeing delays in harvest. Then we're going to start seeing pops as guys have to come to the market and fill those in. But again, it has to be something now that is an unknown or change. The market's well aware of where we're at and have been adjusting accordingly here near term.
So, in soybeans, I don't want to oversimplify the market, but for most of our viewers, we've got the local processing markets across the country, and then essentially you've got an export market out there. And I think you've kind of made it clear that basis levels should be good, but maybe not those extremes. Let's switch over and talk about corn. And again, I'm going to kind of oversimplify for our audience out there, but a Southeast rail market is important to a lot of our viewers. The export market, which would be river loadings in most cases, unless you're up in that northern corn belt in the Dakotas. We got a few listeners from there, and then also the processing market. Which one of those three do you feel like will kind of step up, especially in fall, and be the leader? Do you see one of those sticking out more than others?
I think it's going to be the ethanol side. I think they're probably the least prepared. They've had a pretty rough time as far as profitability. So I think to a large extent, the ethanol folks have been setting back and have been inconsistent in getting coverage. So I think that's going to be the one area that if I was going to see some demand pop would be if we saw oil prices continue $70 plus, and I think Sterling will give you some ideas as, maybe from some of the macroeconomic side, that if we can put some margin into the ethanol side where these guys want to run again, if RINs start popping up again, then I think you could see the ethanol boys step in and need some coverage, and we'd see some extremely strong basis levels. The Southeast, again, that's going to be all predicated on early corn harvest. Are we going to introduce feed wheat into some of the rations? Are they going to need to reach up in those August and September periods and fill in some pockets because the local supply didn't hit like they thought that?
Yeah. 3 weeks ago, now the news was some purchases of South American soybeans coming into the United States. We've normally got a little bit of that, 20 to 30 million on an annual basis. Probably not a big deal. Do you see any imported corn coming into the Southeast that might limit how much these rail markets in the Midwest could move? Is that a worry at this point in time?
It always plays at any point in time. You can see the Purdue's or one of the folks that have Eastern Harbor assets where they can direct a cargo to come in to fill a gap. So yes, if they see that there's an issue, a couple vessels, 3 or 4 vessels coming into the East Coast would end up curing a short-term basis pop.
I'll put you on the spot one more time and to kind of let you give us some general thoughts. I don't want to just have you react to my questions, but you talk to merchandisers across the country. You guys have got facilities across the country. You're also in the middle of a big survey, and I know that you can't let information out too soon, but do you mind telling us about the kind of the crop in general as you guys are seeing it, and also what you're doing in the survey?
You bet. So, as Brooks said, we're in the middle of our annual survey. I think we've done this now for the last 7 or 8 years. We've had very good luck with participation from our producers, and which has also helped us be fairly accurate. We take a lot of pride in being able to come pretty close, maybe not to that USDA number in June. So when the final number comes out in the end, normally we're pretty much within spitting distance. We are seeing corn acres and bean acres both well above what USDA said back in March. I think that's one thing that is factored into the market. I think everyone's going to be surprised if the June report doesn't put some additional corn and bean acres into the mix. I think prevented plant acres over the last 2 and 3 years have been substantial, but I think with higher prices, it's driven producers to plant fence row to fence row and fill in any of those marginal acres that they had in the past. Now, granted, we lost some acres in the deep south, but I think those acres probably will get planted to beans if they get a chance here in the next week to 10 days to get some beans back in and fill in some of those holes that got created over the last 2 weeks by the heavy rains. I still think that corn and bean acres, I think the USDA is, 91 corn, 87 beans. Our number, or let's just say the Charlie Laird number, is probably somewhere pushing that 95 on corn. And I think we're going to be hovering very close to that 90 number on beans. And I think those type of numbers in the short term will take any fear that we would have, if that's recognized, any fear that we have on the drought, it would modify it a little bit. So, I think there's more acres out there. We have a lot of farmers that up their corn acres anywhere from 10 to 20%. And again, we respond to high prices. And how do we respond to high prices? We take advantage and we plant.
So I think it's safe to say I kind of know the answer to this one because you and I have kind of spoken before this meeting. Number one concern right now, from a price perspective, if you're in a farmer's shoes right now, I think you're probably hands down this June 30th acreage report. Is that what you would give it? Yeah.
I don't know if the USDA, and I got to admit, I've been disappointed over the last 2 years with the USDA's process and some of the numbers that they've kicked out. But in saying that, will they close the gap between what the trade thinks on acres in the June report? Probably not. They're not going to fill it all the way. But I think if it shows a trend for increased acres, that will let the trade know that that the acres are probably going to be there in later reports.
So Charlie, I'm not going to let you off the hook that easy. Since you're our guest, I know you think it's kind of lightweight questions, but I'm going to ask the question directly. Are we there yet on prices? Or have we seen seasonal highs? Just what's your candid thoughts on that at this point in time?
So we always have advocated throughout my 30 plus years that you have to be a businessman, not only in the way you plant the crop, but on the way you market it. And what you have to do is mitigate risk on both the upside and downside. The market right now and has been pricing in a risk premium. There's been high volatility. We've seen commodity prices in general extremely high. So I think with current conditions and current belief in acres, the market has got overcooked. Now, in saying that, if this drought continues and we take it in, when you get in a short supply scenario, it doesn't take very long before you start another round of panic. But I think, and I tell my relatives this, like I would tell anyone else, if we look back a year ago, as a general rule, $10 beans, our producers would have been saying, sell me the farm. Now we're at $14 and $15 and people are trying to top pick this thing. You have to take part of what the market gives you and reward them by selling into it.
Well, something that's near and dear to my heart, there's a lot of products out there today that, it is tough to pull the trigger after a big move like this on downside. Even though things are good, there's some great products out there right now that allow a floor with unlimited upside. We we touch on those. We have a daily market letter that goes out. We do our best to touch on those types of strategies from time to time. We try not to beat them into anybody's head, but there are some really, really good products out there that right now producers can use that put a great floor, historically high floor with some unlimited upside through most of October on soybeans and most of November on corn. And if you see that you've got a crop and you've got that crop insurance guarantee, which is what we base our foundation of risk management on at AgriSampo, absolutely nothing wrong with stepping up to the plate and taking a bite of that. Would you agree?
Oh, 100%. I mean, I think at this point in time, from a producer standpoint, to be 30 to 50% sold in this new crop at these kind of levels, you gotta take a bite of the apple. One other little thing I'll throw in here, that they need to do a little soul searching. I think that if Mother Nature cooperates, we have the potential to blow the top off of what our trend yields are, because I think genetics, and I also think because of high prices, everyone's going to be pouring resources, whether it was fertilizer when you did your planting, going back in and side dressing, whether you're going to go out and make sure that you're putting additional pesticides on, or whether you bought racehorse hybrids this year. I think that everyone is investing in this crop, and if Mother Nature gives it, that's the one surprise out there where we could add 3 to 4 bushels to our national average, both on corn and beans, and see some levels that we've never seen before, because I think producers have been given the signal to maximize the potential of this crop. So I again say, if you can't, if you need to get comfortable, you got crop insurance, sell 35, 50%, and don't look back. Don't second guess yourself.
Music to my ears. Well, Charlie, you gave me a great segue into the agronomy side of things and yield, and we've had to have Mike Toohill with us from up in Central Illinois. Mike, we kind of danced around some issues with the current weather situation. Charlie indicated acreage a big deal, but obviously the determinant of where this market goes is this yield that we're seeing. I had one trader tell me that the difference between 170 bushel national average and 180 may mean $1.50 in the corn market. Whether that's up or down from this point in time, I don't know, but a big range. Your boots on the ground for us out there, and you may be boots on the ground in the garden spot right now. But tell us from an agronomy standpoint, I guess I'd first ask you to follow up on what Charlie said. We saw it with the ethanol mandate in 2005, 2006, where technology just ramped up because we had money to invest in it, and it was something that how did we create 4 billion bushels of corn over a period of 6 years? I would have said we couldn't do that, but technology was a big part of that. And Charlie's comments on these trend line yields. What are your thoughts on that? Do you think we'll see some acceleration there as well?
Yeah, I do, Brooks. I guess bottom line is most of the U.S. crop went in pretty good conditions. Stands are pretty good. We did have some frost issues, but as an agronomist, I think the next 3 to 4 weeks are just completely critical. Looking at the weather maps, the state of Iowa's got me the most concerned. Most of Iowa is down 4 inches just for June. One of the driest Junes in history. Their 90-day moisture is pretty rough. And even in Illinois, parts of Northeast Illinois went under severe drought this morning too. So again, I agree there's good potential in this crop. The next 30 days are going to be critical as far as getting some moisture to this corn crop. It's needing the water right now. Even here around Bloomington, about 50% of the corn was rolling yesterday. Normally that's a good thing, get those roots going down deep, but the bluegrass is turning a little bit brown. So again, major concerns here on this corn crop for the next 30 days.
Charlie, you just happened to send out an email this morning with the drought monitor on there. It kind of goes hand in hand with what Mike's seen. Mike, I don't know if you can see my screen or not.
I sure can.
I know that Jason is on here from up in Minto, North Dakota, and I think they've had a little bit of relief, if I'm not mistaken, but you can still see here June 15th. I think this is rated D3 and D4 up here in the Dakotas. And then Sterling's been wandering around Iowa yesterday, and I think he got to the edge of maybe some of these yellow counties. But this is a surprise to me with this map right here. In fact, I thought maybe we got some moisture in here. I know we got some beneficial rains last night, but it looks like Iowa is trending drier. What are your thoughts on these two maps?
Is that to me, Sterling, or to Sterling? Brooks? I'm sorry.
Either one.
Okay, go ahead, Sterling.
What I see is we are trending drier. We picked up some rain in North Dakota. One day of rain does not fix 90 days of not getting rain, and that's a big issue too. We have a heat issue today in Omaha. It's going to be between 104 and 106 degrees. The hottest day ever recorded in Omaha is 109 degrees. So the heat is supposed to be relieved towards Monday, Tuesday, and there's a chance of rain. The market is going to be trading off whether that rain in fact verifies. We've gotten a little bit of rain here and there. There's areas, if you're farming northwest of Lincoln, Nebraska, you're going to be getting a new pickup truck this year. If you're farming 15 miles outside of Le Mars, Iowa, well, maybe you can afford some ice cream. It's two different situations, and these crops are starting to reach a stress level in Iowa.
So
Mike, Iowa's the state I'm watching the closest.
Yeah,
and a tough year last year too to follow this thing up, Mike. So the stress that Sterling's talking about is real stress. It's out there. What I'm seeing in my neighborhood, and I think what you're seeing in yours, you're seeing a crop that you can kick down half an inch, and you got moisture. But boy, if you drive by it right now at 1, 2 o'clock in the afternoon, it's rolled up tight. What's going on with that corn? Are we hurt there, or what's the deal?
No, in that case, we're not hurt. The corn's doing its job. It's protecting itself, conserving moisture. But when you start talking moisture deficits, there is a time in 2012, the Illinois corn crop looked fantastic in June. Everybody talked about how green it was and how consistent it was, but we kept forgetting about the moisture deficits. And like Sterling was saying, in a day like yesterday with the close to 100-degree temperatures, low humidity, no wind, between evaporation and crop loss, we're going to lose about a ½ inch a day. So again, these moisture deficits are hard to make up. And one thing too, you have to think about the traders, especially, they look at the radar overnight and it looks like we're getting 1 to 2 inches of rain, but you talk to the farmers on Ag Talk or social media, thundered and lightning for 4 hours and got a tenth or two. So again, big difference between what the radar is showing and what's actually boots on the ground type of moisture. Here in McLean County, my folks got 2 inches last week. I talked to an uncle 10 miles away. He's had 3/10 for the month of June. So extreme variability, some pretty major deficits. Now this crop could flip. You get a couple 2-inch soakers across the corn belt, I think the party's over, but we got to get those 2-inch soakers to get this corn crop, and roughly 30 days to make the difference.
Right. We are definitely getting on the clock on that. And looking at the forecast going in the next 10, I don't see much. And if what rain is advertised doesn't verify, well, now we're down to a couple of weeks, and I think the market can get pretty nervous about that. Certainly for the corn. The beans, well, they're beans, but that's a different story.
Long time on the soybeans, yeah. Learned that lesson in 2012. Corn was done and beans held on.
Absolutely.
They did fantastic.
Absolutely. Yeah, a little bit of rain there in the end of August. It's amazing how quick those bean plants recover. It's a marvel of modern engineering.
So Mike, I'm going to ask you a question about soybeans. I think a lot of people have got this question on the call. As a rule of thumb, a lot of the country planted 20 to 30 days earlier than normal. The beans, they were slow to emerge. They were slow to grow. I hear that comment a lot of places. Okay, it looks to me like the later planted beans have virtually caught up with the early planting beans. We got ours planted a little early. They never looked what I would call good. We didn't have to replant. They didn't look good. How in the world does that translate to better yields? Because visually, I don't see any difference. Do you still think we'll see that yield bump from early planting, even though they don't look the same, or they look very similar?
I guess to talk about early planting soybeans so far this decade, Brooks, in the years the early planted beans really shine is when they go in the ground early. They come up, they don't get frosted off, and by the summer solstice, which is Sunday, the rows are canopied and there's flowering and setting a few pods. And this year, like you're describing, Brooks, the early beans have got lower stands, lots of frost issues. I just don't see a big yield bump from early beans. This will be 2 years in a row. So again, early beans got to come out of the ground screaming. They got to keep growing. And they can't get frosted 4 to 5 times. I don't think there's a yield penalty per se, but I don't see a big benefit for April 1st beans versus May 1st beans versus the 15th. Again, they just never got the growth pattern to get that early growth and to get that early flowering and the early reproductive stage going.
Right. So I'll ask this to all you guys. 50.5, I believe, is a trend line yield. You guys correct me if I'm wrong. Does that sound accurate? I'm going to pull up my spreadsheet, but I believe that's right. Sterling, do you concur?
Yeah, that sounds about right.
So we're talking about
number.
one bushel is going to impact carryout 80 to 86 million bushels, which is big, because going back to WASDE's meeting last week, I think we put carryouts this year at 150. We don't see a substantial decrease from that. That means, perhaps if that number's static going into 2022, 80 versus 220, which is still 80 probably moves the market. 80 million bushels carried out. 220, maybe it doesn't change things. What are our prospects, Mike? I mean, at this point in time, are we way too early to say maybe we're hurt by early planting, or when do we have to wait to kind of make that call?
I guess at this point, I'm going to say early planting is more of a neutral. Still probably looking at the data, probably a slight improvement. I guess my biggest concern on the bean crop today, looking at some of the spring wheat pictures coming out of North Dakota, a lot of that spring wheat is headed at about 6 to 8 inches tall. Here in Illinois, we've got plenty of time on the soybeans. Sterling and I learned this lesson in 2012, but I think up in the Dakotas where they're running on 10, 12, 14-inch moisture deficits, if those beans only get 6, 8 inches tall like the spring wheat, they're in a world of hurt. So again, I'd kind of watch the Dakotas right now. Here on the better soils, we've got plenty of time, Iowa, Illinois, Indiana, to watch these beans. But again, I'm really watching some of the spring wheat pictures coming out of North Dakota and make you want to cry. Just looking at people in their wheat, 6, 8 inches tall headed out. And again, it's probably just as much the heat and the wind on the wheat as versus the dry weather. So there's some things working against this crop in a lot of areas.
So, Mike, I won't put you on the spot as much as I did Charlie, because I think that you've got an out, because you can always claim weather on here. But from a yield perspective affecting the market, are we done yet in regards to prices? What's your opinion there?
My own personal opinion, I'm not a marketer. I'd be putting some of my money in the grain market today. I think there's one more pop on this corn market. But again, a couple 2-inch soakers across the I-states before July 4th, and this thing goes away. But you keep getting these 1 to 2 tenthers when you're supposed to get 1 to 2 inches. And these moisture deficits, like we learned in 2012, are hard to overcome. But we also know growing corn in the Midwest on dark soils, normally you got that good subsoil moisture to get you through, and that's just not the case in much of Iowa and parts of non-irrigated Nebraska. The Dakotas are awful red on that yield monitor, and even as close as I-80 north in Illinois, not much subsoil moisture to go. But again, it looks like to me a 3 to 4 week market on this corn. Get some rains, the thing goes away. It stays dry. Who knows what this thing is going to look like? Although I do agree with Charlie's comments. The guys put a lot of effort into this crop and a lot of expense, but still takes water to grow corn.
All right, Sterling, we've talked about the obvious. We've talked about supply. Charlie's kind of walked us through there, maybe some small declines in usage to help things out, but not a big thing there. Guys, I kind of thought Charlie might give us a little bearish tinge to it. Maybe reality was setting in. Mike's somewhat optimistic that maybe the party's not over. Maybe we're looking at the things that are too obvious here. Maybe we're looking at only the things in front of us. Is there anything on the periphery that might be affecting our markets right now?
Oh, yeah. We're definitely going to talk about some global macro things. Can everyone see my screen?
Mm-hmm. Looks good, Sterling.
Yeah, this is the Bloomberg Commodity Index. And as you can see, we've had since March what some people might call a breathtaking reality in commodity prices. Now, let's put this in perspective. We're going to go back in time. We're going to go all the way back to the year 2000. You can see where commodity prices were at their peak of the boom. The index was sitting at about 238. We're not even at 100 yet. So to say that we've had a big commodity rally, yes, that's true. But when we look at it in a bigger historical perspective, we do see, plenty of room for a bounce. A couple things that I'd like to point out here. Peak was made in 2007. This was prior to the crisis, obviously, in 2008. The economy was blowing and going, and gasoline was $5 a gallon in California, and all that was going on. Here, obviously, we had our big crash. What I'm really more interested in looking at is this period right in here. This is the recovery. So if we think of this, the pandemic break, as something similar to this, where we had an economic shock and we had this bounce, we may have plenty of room here for the market to move up, and we're certainly not in uncharted territory from a macro point of view. So, is there potential for things to go higher? Absolutely, especially if the economy, as we transition out of from what we were to what we're going to be, I think there is definitely potential for further commodity prices moving up. We're seeing a change in living habits and things, all of which are fundamentally bullish to commodities in the general sense. Now, when we break that down to what's going on today, we're going to take a look here very quickly at the price of what is a unreal commodity. Gold is not a real commodity. It is not a currency. It is not something that you readily use in an industrial manner. It is essentially a currency. It is the anti-dollar. And if we take a look here on what's going on today, we can see that the gold market is getting beat up badly. After actually seeing a fairly positive trade day yesterday, yesterday's price action was actually bullish. We started out, we got crushed, and we came back up all the way back to where we were. Normally, we see that as kind of bullish behavior. As you can see today, obviously, we have other ideas. So what we're seeing is a reset. This is coming in the heels of what the Fed said, and whether they really have control of inflation or not is going to be dependent on, one, if we see commodity index buyers. There's two kinds of commodity funds. There's speculative funds and there are index funds. When you have people who want to invest in commodities in general, typically, if they're moving a lot of money, I'm talking 6, 7 figures here, normally they don't call up a broker and buy futures contracts. They come in and they buy index funds, and index buy a broad range of commodities, unlike buying the S&P 500. If we were to see that, that is something where I think we can definitely see prices begin to move higher across the board, and that is something, a rising tide will lift all boats, and that will help put a floor under the commodities and the grains in particular. What I see today is I think we're having a lot of the baby being thrown out with the bathwater. There's plenty of fund managers and plenty of people who don't really care about the numbers I'm going to show you here in just a second. They care about, well, corn's a weed and it'll grow, and if it doesn't rain, it doesn't matter, and all that. That's the extent of their knowledge. They don't really look under the hood. Now, what I'm going to show you here next is right here. This is hog production margins in China. Okay, as you can see here, this is obviously ASF in the pandemic. Hog margins soared. Hog margins have now collapsed. Well, yeah, and they're negative. But if we look historically, well, actually, they're back to some people might call normal. And if you interpret this negative margin number as being bearish for corn, you're correct if you're in the United States. This is China. Number one, anytime I look at Chinese data, I just look at the trend. I don't look at the numbers specifically because getting the facts, well, it can be a bit of a challenge. But what we're seeing is hog margins are coming down. What does that mean? That means they have hogs, and they're big. In fact, I picked up an article that was showing some Chinese hogs clicking the scales at 200 kilograms. That's 440 pounds to you and me. That is a big pig, and that is becoming more and more common. The next thing, Muon is the company over in China that is their largest pig producer. They showed their sales up 160% year over year for the first 5 months. That tells me the hogs are back in China, and they're coming back in a big way. In the broader sense, that is going to be bullish for corn simply because if you have more consumers, you're going to inherently have tighter supplies. China's going to be hosting an Olympics here pretty soon, and as we saw at the run-up the last time they did, they were quite big about buying food and making sure they have no social unrest, no concerns. So Food security is always important in China. Let's say for the next 24 to 36 months, it's going to be highlighted. So negative margins, they don't care. Everyone's going to be getting plenty of food. The next chart I want to show you here, this is a chart of their hog supply. And again, I don't want you to think about this as an absolute number. What we've seen here is ASF, and we've seen this trend change. My guess is the market is actually probably noticeably higher, but once again, information that comes out of China is very much throttled, it's very much controlled, and if there were a lot more hogs, the Chinese government is not going to go out and advertise that simply because they know they need to come in here and buy feed. So from this point of view, we have a fundamental shift that I'm guessing is going to be more permanent in that we are going to have bigger Chinese hog supplies. We are going to have bigger Chinese feed demand going forward. This is something that once it gets into place and it's habituated into people's diets, it's going to be very hard to take away.
Sterling, I got a question that came in, and it was something. It's a question that you and I talked about prior to the meeting today, and I'll repeat it for the good of the group. But with decreased margins and margins at a loss in China, why aren't we seeing some liquidation of numbers and hog numbers go down? Is the question.
Simple fact is China is not a market economy. They don't care about losing money. It's a communist regime. They care about food security. Somebody's losing money processing hogs, guess what? They get a check from the government. It's a command control situation. It does not work like a free market economy does in the United States. So comparing the two is like trying to compare a diesel electric locomotive to a steam engine. Two completely different sorts of animals that have different behaviors. When we think about China, we need to think about what does the Chinese government want to achieve, not what it costs.
That is I think a pretty good explanation of why these numbers could continue to sustain themselves long term. I appreciate that.
Not a problem. So with this global macro situation in place, this could be very simply a storm that we're going through. We need to pay attention to the Fed and how they actually handle things. And if we begin to see interest rates really go up. Now, if we look at current interest rates, here, I'm going to punch those up here real quick. If we look at where 10-year interest rates are right now, at 1.53%, if we look at the overall trend, you know, they went up on the comments yesterday, inflation concerns. Today, they're right back to where they are. Something to keep in mind, the Fed is probably not going to be terribly aggressive in their behaviors in changing and cutting back the number of bonds they're buying, in affecting any of these things unless they begin to see real inflation that is not something that's situational or transitory. You know, I talked to some reporters yesterday about inflation. I said, well, corn prices are up here. I said, corn prices are the same price they were in 2012. That's not inflation. Inflation happens when your balance sheet says corn should be $4.50 a bushel, yet it's trading $6 a bushel. That's real inflation. We are not there. We are going through a transitory environment right now that is filled with volatility. And as Mike pointed out, if we don't get these soaking rains, we're going to be looking at a different reality come this fall.
Sterling, I'm gonna back up here. On one of our third Thursday meetings, it's been probably 4 months ago now, we looked at that consumer price index versus corn price, and we saw that direct correlation from about 1968 to 1983, where that argument of inflation and commodity prices could be made. But I think you did a really good job of illustrating from 1983 with the consumer price index, with a little less emphasis on energy and food in that index, taking a smaller bite of that index. We haven't seen that correlation at all. I'm putting you on the spot to kind of pull up some data pretty quick, but give us the illustration on that if you don't mind.
Coming right up here, and there we go. And second here. Let's see.
So while Sterling pulls that up, I'll clarify kind of what he's going to show us. For those that would argue that the corn price at $5.64 is due to inflation, Sterling's going to provide some data on here that really goes against that notion. There was a time historically where there was a very close correlation to inflation and commodity prices in relationship to corn and soybeans. But it looks like that ship has sailed several years ago.
Yeah, that ship has sailed long ago. Here, let me get this data pointed out here. Let's get the CPI numbers here. Okay, so this is urban consumers less food and energy right there. So when we take that out,
while you're pulling that up there, the CPI index, it's kind of a slang. It's not exactly right, but it's what we would call inflation and deflation measurement. And it takes into consideration an average urban household, and it measures what they spend on a monthly basis in different categories. So one of them might be energy. One of them, of course, is food. And while he's pulling this up here, if you think back, there's a few viewers that were paying bills back in the 70s. Not that many, but essentially we paid a larger portion of our budget for food and energy needs through that time period. CPI, as years have progressed, a lesser percentage of that household income has been spent on energy and food, really starting in the 1980s until today. So, Sterling, you've got a really good illustration on here, and I can see that one-to-one correlation. Walk us through what you're seeing there.
Now, here, if we go back here and we look at food inflation, measured as price of corn. Corn is a basic building block of the American diet. You can see here that we clearly had some spikes going on. And we had the corn market does trade with some independents, but there's pretty good correlation in here. Now, if we look in here, we saw very strong corn prices. We have the drought here, and then issues leading up to the year of the drought, where we had drought issues in Russia, for example, with wheat, and that pushed prices up. CPI was not very strong. Now, we see this correlation here. First of all, correlation is not causation, and things can, in fact, be a coincidence. We were leading up to this grain market with what was going on well before any of this consumer inflation, before the price of houses went a little bit silly and things like that. So the fact that we see this happening does not mean one is causing the other. This is an incidental factor. I think if we had not had the pandemic, nothing had happened, we'd probably still have corn prices here, if not higher. Simply because if we had not had the pandemic, Chinese pork consumption would be higher. Those pig prices would be firmer. Their willingness to pay up would be greater. You would see consumers have a lot of money in their pocket. Consumers went through a period of austerity and their behavior has changed. Had their behavior not changed, again, probably bullish for corn. So the fact that we're seeing this little blip up here, tying these two together, I think is more a leap of faith than a leap of actual fact to what we see really going on. But again, inflation and corn, very much two very different things. And if you look and measure at, if you look at like the cost of a color TV, I remember in the 70s, my parents bought a new color TV. It was $600 and it was 25 inches. If you adjust that right now, a new 25-inch TV, if you adjust for inflation, that TV is going to be like $5,000. So we really have moved away from really seeing commodity prices really as a driver of inflation, particularly in the food space.
Sterling, one of the things, I mean, we've seen this little sell-off here. We saw some rhetoric out of Washington early in the week when it came to blenders' requirements on biofuels, soybean diesel and ethanol primarily. We talked about that as posturing. Every major news outlet talks about inflation right now, specifically the cost of gasoline, the cost of diesel that's out there. Are corn, soybeans, and wheat, are they feeling any effects of that type of maybe rhetoric or pressure on Washington to control things a little bit.
Well, the one thing I would like to point out is very often we have a situation where the president wants to do something, he wants something to change, and he doesn't want policy. And this could be any president, you name him. All of a sudden they start to talk and you get a little bit of rhetoric going, and that moves the ball. Is he going to change the blending requirements? Is Joe Biden going to do what Donald Trump was doing? I wouldn't wager on it with my money. So he talked, the market moved. Maybe he got the result he wanted. But again, we also have to think about when we see the news and we read the news, you have to think about there is a big news cycle. It goes 24 hours a day, and it goes constantly, and they need things to fill items. What I'm putting up here now is the price of gasoline from the futures contract. So while local prices will be different, this is our best way of looking at wholesale gasoline prices. So as we can see, obviously, from these lows, gasoline prices have gone up. The absolute low of this was 37 cents a gallon. Have any of you paid 37 cents a gallon for gasoline ever in your life? Not even close. You have to remember one thing, the price of crude oil went negative. It was negative $50 a barrel, for goodness sake, when the economy locked up, and all of a sudden you have all this energy, all this oil sitting here, and you have no place to put it. That was the first thing that really knocked the tar out of gasoline prices. But if we look at where we are right here, right now, and we draw a line here, I'm going to put a horizontal line on here, and we put a price where we are right now. Gee, it looks like we're at the same price that we were at March in 2019. We're the same price we were in March of 2018. So is there really inflation here, people? Looks like to me normalization when you really look at the hard facts of what's going on. So people like to see and measure these things on a relative basis month over month. Yes, you're going to see crazy inflation prices because you're not going to get away with gasoline at 37 cents a gallon. It's just not going to happen. So we need to put this back in perspective and remember that the fundamentals at the end of the day will win out. And I think Mike was right on the hit the nail right on the head. Really depends on whether it rains out here. You know, you can probably measure this market by looking how much grass I cut off my lawn. It's down 60% in 2 weeks. So,
Sterling, you talk about fundamentals. I'm going to switch the screen over just very quickly and look at the balance sheet. And Charlie, this is something that you see on a daily basis. But let me see if I can if that's pulled up. Basically, this is a very, very simple supply and demand chart. We've adjusted our carry out here, Charlie, to 150. So when we get back to fundamentals, this is really where we boil down to. 90 million panel. Do you like 90 million planted acres on soybeans, or is that as high as it can be? What is that fair?
Fair. Yes.
Throw it out there. And of course, we harvest the vast majority of the soybeans that we plant. So that's 89 million that are eligible for harvest. Things like what happened down in Mississippi are factored into this. In Arkansas, that flooding. There's our 50.5. Now this is lofty right now. And I would say, you know, this is probably the variable right now that once we get past June 30th report, this is the variable everybody looks at. And as you guys know, you can walk into your own soybean field every day and to try to judge your yield within 5 bushel the acre, good luck. So we won't know. This is the unknown. Just kind of looking at this and taking 150 million from last year, plugging into our carry in. Our imports stay relatively similar. We might tick those up a little bit, Charlie, to 30 million after what we saw this year. Crush it down just a smidgen at 2.135 billion. Exports maybe off a little bit at 2.2 billion. You can see it's hard to build stocks when it comes to on fundamentals, and I think Sterling's going to kind of take us away on this. That for this thing to be 250, Charlie, you live these numbers every day. Can this carry out be 250 million in 12 months from now?
Yes, it could. The one thing that I'm still, again, there's a lot of unknowns. Mother Nature's pulling the stick here. Could we be 52 yield. Yeah, it's possible. I mean,
At 52, let's just look at things at 52, which it would take a heck of a crop to get us there. I think that would be probably the pie in the sky number. We build to 336 million. So I think that if we sit here and look at this and we assume slight dings to exports and crushings, 336 could be the high water mark on carryouts. Let's adjust this yield in the other direction in a modest way. Let's take us to 49. And really the point of this is I want to illustrate how much half a bushel is. That's a 68 million carryout. So just think about that. 3 bushels is what we just adjusted things from 49 to 52. It looks as if the market has to stay on edge here for a little bit. Charlie, looking way out there ahead, I guess the one thing that what this shows me is bean acreage. If we had another chart out here for 22, 23, I think all odds are on an increase of bean acreage across the country. Does everybody kind of agree with that? That's one way we start to fix a problem.
I think, and I'll throw out, it's not just across the country, it's across the world. So remember, we're 6 months away from a bean. So, South America, again, they've had some weather issues, but you can fix the world supply and demand chart very quickly, in about an 8-month period from now, let's say, if South America has a large crop. I get asked a lot, what's these numbers telling me? What can it do with prices? And if I had to bracket bean prices right now with what we're seeing, we're probably talking about somewhere between $10 to $16 a bushel is probably the life that we're living in with these kind of economics.
And I didn't get a chance to give Sterling's take on this, but I want to, as far as are we done yet with prices, Sterling? I'm going to ask you that in a second, but Charlie brings up probably the most important point to drive home with our farmer customers and our agents out there. Regardless of whether we yield 48 bushel or 52 on beans, regardless of whether we yield 170 to 180, we will fix the supply problem. It's a matter of how many crop cycles it takes. And Charlie brings up a good point. We've got Brazil growing at a 3.4% rate annually. We have got vast improvements, given some stability in Ukraine from a political standpoint. Ukraine has the potential to increase yields 20 bushel the acre in corn relatively quickly with a little technology introduced, and really not new technology introduced, new technology to that area. So the issue is here, whether this rally continues 6 months, whether it continues 12 to 18 months, to bet on a sustained price situation like we're in right now is really to bet against the farmers out there, and I don't want to take that bet. We will figure out ways to tweak the system in regards to usage to fit. We're going to figure out ways through technology, through increase of acreage, to meet the demand. So we're in a time period here, Sterling. I'm going to throw it back on you. I think we all agree that long term, these are great opportunities, and this will go away. Sterling, short term, I'm going to put you on the spot. Are we there yet? Are we done yet?
No. In fact, I think we are, if I were going to say we were done with anything, I'd say we're probably done with the beatings. I think we may, here, I'm pulling up here. Let me pull up one more little thing right on here, put that there. And taking a look at where the market is right now, we're at 555 in the orders on Dees. We're down 16 3/4. So we're trading 8 off the lows. The retracement level is 539. Well, if you want to be brave, if you're a 50-lot trader normally, if I were bullish, I'd come in here and I'd buy 5 right now, right this very minute. It looks like, you oversell markets, you beat them up, you beat them up, you beat them up. It looks like to me we've stretched that rubber band near term about as far as it's going to stretch. And you're playing with the weather here, so you're playing with the snake. But looks like to me we've stretched it.
So we're right in the middle of this volatility period. The one thing that is crucial here is I think if you held up your hand, all four of us would say we've got opportunities over the next 6 weeks. I also think if you said, should you take advantage of these opportunities over the next 6 weeks, everybody raises their hand and says absolutely. Charlie, you head up origination at CGB. I know you don't have to go into great details about some of the products that you've got, but you've got products out there like an equalizer min-max, and you've got even some traditional products out there, maybe even some market premium pluses out there. Can you kind of give us the backbone components of how a contract like that might work? Because I think this is probably the most important information we get out to our viewers today is, we talk about taking action. How do you take action here, and what kind of product do we look at?
In this type market, I'm a huge fan of min-maxes with a pretty wide window. It's going to cost you a little bit because of the volatility that's out there. But I think that if you can get a floor here at these corn in the 550 range with an upside of 50 to 70 cents, I think that is a solid start. If you haven't sold anything at all, I would challenge you to really scratch your head and look at some of the products that are out there and maybe get some floors on this thing. I even think that if you're in that 20-30%, that you need to start looking at levels that you're going to feel comfortable pricing into. One thing I will challenge: there's a reason you guys buy crop insurance. Is so that you can be more comfortable making your marketing decisions. So utilize crop insurance the way it was meant to do, and to really, do yourself a solid business decision and take advantage of what the market's giving you.
Sterling, you keep track of a lot of these products. I'm going to kind of switch you over to soybeans. I'm going to show a soybean chart on here, maybe. And to look at soybean chart, Charlie talked about maybe some min-maxes out there. You can take control of it. You've got your chart in front of you.
I can bring up the soybean chart right here. Here, let me go ahead and grab that here. And the soybean chart, you can tell the corn's the leader. The soybeans have been getting drug along, kicking and screaming here. They have not been able to rally really on their own merits, and this chart really belies this. As you can see, the corn actually bounced after it made a low today. So there are people out here, they're willing to buy corn. Soybeans, 1306, your lows 03. When the corn bounced, the beans didn't. That pretty much tells the story. I do think if you need to put on some coverage, some reownership on the board for corn, if you do it short term, because here's the thing about the corn. We're going to know one way or the other, probably by the 1st of August, maybe by the 10th of August for sure, whether or not we had a pollination problem. We're going to know. There's no need, if you think you need to reown or you have a problem, there's no real reason to chase it all the way out to December and pay all that premium. Soybeans are a different story. The plants behave differently. And as Mike mentioned, we saw recovery from a pretty bad situation the last 2 weeks in August. So from a marketing point of view, I think putting min-maxes on the soybeans still makes sense. These are still really good prices. If we're going to see higher soybean prices, it is going to be dependent on corn prices going up. Soybeans right now, unless we go into a full bore drought and it just quits raining altogether, soybean prices are probably a little more vulnerable. The Chinese need, the export need, it's about the corn right now. So I kind of view these, normally I kind of look at them as the same, but any weakness will be more pronounced in the beans. The strength will be noticeably less in the beans, I think, at least for the time being.
Interesting comment there, Sterling. The market tends to think 2 to 3 steps ahead of us. and Sterling made mention it's about the corn. If you look at the balance sheets, you think, well, it's clearly about the soybeans. The soybeans were tighter. There's a chance the market is already eyeing the 2022 crop here. If we can build a little bit of corn stock, meaning maybe we can get carry out to 1.7 billion, probably at the most, in 21, 22, it eases some acreage restrictions from corn to soybeans. It makes it easier. So the market's a little bit ahead of us here. It's starting to look at things out in the future.
And along with that, they're already looking at, more importantly, that South American crop, and the fact that we're 6 months away from fresh soybeans coming in and coming into play. So that's a little bit different. Along with that, variability in soybean yields are not the variability that you're going to see in corn. This corn that's got planted north of me in the Dakotas, it's in deep, deep trouble already. And even if we get rains, we're probably sitting on diminished yields. And drought begets drought. I don't see anything in any forecast where the high pressures are going to be placed. I see drier where it's dry and more moist where it's wet. And we're going to see that this weekend. We're not getting rain in the Dakotas, but down in Louisiana and everything, it's going to be a soaker. So.
Well, we've been on for about an hour, folks, and I want to recap just a little bit. We'll wrap things up. We appreciate Charlie being here. I think Charlie's insight into one of the bigger takeaways that I got from his comments were this is a little different market from the standpoint of we almost were able to plan. If you were a processor, if you were a feeder, we were almost able to plan for this a little bit. And so we took some steps early on to prepare ourselves where we weren't surprised in a big way. Small cuts to usage, but maybe not that drastic cut that you might see with $14 beans and $7 corn in the past. Mike's points that we are smack dab in the middle of our highest volatility period in regarding a crop should provide opportunities further into the summer. Maybe even into August, maybe even a little later than what we're used to this year. Back to Charlie again. What are we looking at over the next 60 days? That could be a game changer. June 30th acreage report. Now, remember, there's private estimates out there of 96 million. So it all depends on what the market is trading right now. It's trading 95, 96. What's out there? Sterling brings up some really good points. It's not about inflation. We might be seeing some sympathy in our commodity markets with things that are going on elsewhere, but you can tell Sterling's got he's got the bullhorns on with his comments today. He thinks that we've got opportunity. The bottom line from all this is all of us on this call believe that you should utilize the risk management protection that AgriSampo provides. With our insurance guarantees. There are products that are very conservative in nature. They may be new to you, but they're conservative. They give you floors. They allow you upside. We all believe that within 24 months, some of these opportunities may vanish right in front of us. The market has a tendency to do that. Take advantage of this. We've got 90 days in front of us that look like some great opportunities. And the cool thing about this is you may be shaking your head that I don't get it. I didn't get enough information on the meeting. All of us on this meeting would love to talk to you individually. We love to meet with you and your customer. If you're an agent out there, we'll walk through this thing in a way that's not scary, in a way that we can explain it. We will not only walk you through the products that you think you may want to use, we'll look at all the scenarios of how things can play out because we understand you could make Charlie, we could have somebody enter into an equalizer min-max and provide a $5.50 floor with $6 upside, and it's still no fun if you don't have the bushels to fill that contract. We'll walk you through the scenarios that you need to know in the event that happens. I know it's easier said than done to market a crop before we know what's out there, but we can kind of help you know how to handle different situations. So the big thing is we want you to take action, we want you to lock these in, and I tell you what, we had a pretty good team approach today, Christy. kind of a 1-2-3 punch with Charlie and Mike and Sterling talking about cash markets, agronomy, outside influencers out there from Sterling. So a good meeting overall. I think there's some optimism short term, but there's also a call to action, I think, over the short term as well. So I appreciate everybody joining us. Christy, what do we have to look forward to coming up? I know we've got a big June 30th report date. Tell us what's in our future.
And I'm going to tell you, there was so much information just in this last hour. I do want to remind you all that today's webinar has been recorded. We've had a couple questions, people asking if they could see things again. Yes, you can. We're going to have this on our YouTube page as soon as possible so that you guys can get right into this and see what's out there. We do have some really cool things. We have our third Thursday next month. So on June, let me pull it. Sorry, July 15th. We have like our super producer marketing information services week. It's like a full week of everything you need to know. So that Monday, which is the 12th, we have our WASD report, and then that Thursday we have our third Thursday meeting. So we have a full information week. But right before that, again, we have that June 30th stocks report. That is so important. That acreage that's going to be announced is really key. And we know that that's going to really make a difference for all of you. Are there any other questions? David, I see that you've asked to see the table again, and we'll get that to you. Are there any other questions before we go on? No. Well, as we're waiting for maybe a few to show up, let me show you something here really cool. Brooks and his team have been working on our 2021 virtual crop tour. Now, if you have missed this, you have missed some really great information. Just let us know when we'll get you those old reports. But we are getting ready to start week 6 on Friday. So make sure you get signed up for the Daily Market Outlook email, and we will make sure you're getting this because you're not going to want to miss the week 5 survey results and information, the report that comes out Friday afternoon. So, is there any question with that, Brooks? I'm sorry, I thought somebody said something. But anyway, we've got Brooks and Sterling and Mike. They all offer commentary throughout so that you guys can see what's going on throughout the report. You can sign up again at marketinginfo@sompointernational.com. Again, getting you ready for this super week in July. We have Monday, July 12th with our WASD. And then we go right into the third Thursday meeting on Thursday of that week, July 15th. We want to thank you again so much for joining us today. Again, it's just been chock full of information. And I know you're not going to want to miss being a part of all of this and seeing it on down the road and even later this week. Hopefully, if we can get it out tomorrow, we sure will. It might be Monday because this has been a little longer video. These will all be on our YouTube page, but we will share the links in our DMO. All right. I think it's been a great meeting. Thank you, Charlie, so much for joining us today. It's been great to have you. And Brooks and Sterling and Mike. Mike has some slides that will be available as part of the video. So you know, we missed a lot of his stuff. He had some really great slides to share. So I don't have anything else. Anything else from you guys? Parting word?
We're good.
We're good. Thank you.
They're all
Thank
talking
you.
a bunch. We love having them, and we loved having you. Thank you again so much for joining. Have a wonderful, wonderful crop season. We'll talk to you next month.